In this comprehensive guide, we'll show how to use the Mix 1 EMA cross and trend channel indicator as a complete trading system. You'll learn how to identify high-probability setups, manage risk effectively, and execute trades with confidence across different market conditions. Let's dive in. Created by Gu5 Tavo 71, this Pine script indicator combines three technical analysis frameworks into a comprehensive trading system: EMA crossovers, trend channels, and the classic golden cross. The indicator identifies market direction by analyzing the relationship between faster EMAs, default 26 and 50 periods, alongside a longer-term moving average, default 200, that establishes the primary trend channel. The system creates a dynamic trend channel based on ATR-derived boundaries around the main moving average, allowing traders to visualize price action relative to the underlying trend. When price operates within this channel, the market is considered ranging, while movements outside signal potential trending conditions. The indicator then synthesizes this information with EMA cross signals to generate actionable trading opportunities, offering two strategic approaches: entering trades on direct price EMA crossovers, or restricting entries to periods when the shorter EMA demonstrates upward momentum. The system incorporates customizable stop-loss functionality based on percentage risk and provides clear trade signals through icon markers on the chart. Period restrictions allow traders to limit trading activity to specific time windows, ideal for session-based strategies. The indicator excels at trend filtering by requiring alignment between multiple timeframes and technical elements before generating signals. Traders can also enable golden cross detection between the medium-term EMA and long-term MA for additional confirmation of major trend shifts. The Mix 1 indicator is most effective in trending markets with clear directional movement, where EMA crossovers and the trend channel help identify momentum shifts. In ranging or choppy conditions, the system's confirmation layers help reduce false signals, though trade frequency typically declines. When key support or resistance levels align with the trend channel boundaries, these areas often serve as effective signal zones. Volatility also affects performance. ATR-based channels expand in volatile periods, giving price more room while preserving signal clarity. Timing matters. The London-New York overlap offers the most reliable signals due to increased liquidity. The Asian session, with lower volatility, often leads to narrower channels and fewer opportunities, requiring more cautious sizing. Weekend gaps and Monday price action tend to shift technical conditions, making Tuesday through Thursday more consistent for execution. Solid risk controls turn the Mix 1 strategy into a reliable tool. Risk per trade should remain under 2% of account equity, adjusted based on the stop-loss distance. This keeps exposure consistent across varying market conditions. The strategy typically targets 1:2 to 1:3 risk-reward ratios. In strong trends, extending to 1:4 may be justified. Near major technical levels, 1 to 1.5 targets are often more appropriate to capture gains before potential reversals. Drawdowns should trigger size reductions. After 3 consecutive losses, halving position size helps preserve capital and maintain discipline during underperformance periods. While Mix 1 provides defined entry signals, additional filters improve quality. Volume analysis is effective. Strong volume confirms breakouts, while weak volume suggests waiting for a retest. Combining Mix 1 signals with confluence zones, for example, support and resistance, Fibonacci levels, prior highs and lows, increases the probability of successful trades. These areas often align with EMA crossovers or channel boundaries, allowing for confident entries and, at times, larger position sizes. Scaling into trades offers flexibility. Enter half the position on the signal and the rest after confirmation, such as the price remaining outside the trend channel for several periods. This approach reduces the impact of early reversals. Exit strategies go beyond static targets. Trailing stops based on channel dynamics help capture extended moves. A top-down approach strengthens strategy application. Begin with the daily time frame to establish the broader trend and key technical levels. The 200 EMA here acts as a filter. Only trade in the direction it confirms. The 4-hour chart provides tactical refinement. Its channel boundaries often match intraday levels, and its EMA crossovers reflect momentum that can persist across sessions. Use the 1-hour chart for execution. Signal reliability improves significantly when it aligns with higher timeframe trends. Converging signals across multiple timeframes justify more aggressive trades and larger profit targets. Documenting these multi-timeframe alignments helps reinforce discipline and improves pattern recognition over time. The strategy works best in moderately volatile trending environments. Both low and high extremes in volatility can reduce reliability, either by limiting signals or increasing stop-outs. Optimization should match the indicator to specific asset characteristics. More volatile instruments may need longer EMAs to avoid whipsaws, while stable assets may benefit from faster settings. Avoid overfitting. Test adjustments in forward conditions before applying live. Consistent execution requires strict adherence to preset rules. Criteria should include multi-timeframe alignment, acceptable risk-reward profiles, and a clear market context. Avoid impulsive trades even if signals appear strong. Plan trades before the session. Use conditional or bracket orders to automate stop-loss and take-profit placement, minimizing emotional decision-making. Focus monitoring on price behavior relative to trend channel boundaries and EMA direction, not short-term fluctuations. Prepare for exits as price approaches technical extremes or indicator signals momentum loss. Maintain a trading journal. Record not just trade data, but also market context and your own decision-making process. This helps refine the approach and build discipline over time. Common pitfalls include overriding rules based on news, ignoring stop losses, or changing targets mid-trade without valid technical reasons. A consistent pre-market routine reinforces strategic commitment and helps manage emotions. Mix 1 can complement broader strategies. For example, sector rotation methods benefit from its trend filters, which highlight momentum in specific market segments. Additional indicators like RSI or volume tools can enhance signal validation. For instance, RSI divergence at channel boundaries often supports reversal signals, while volume spikes confirm breakout strength. Adapting the strategy across asset classes requires understanding their unique traits. Forex offers continuous trends and liquidity. Stock indices trend well, but require care during consolidation, and individual equities benefit from Mix 1's filtering during earnings season or after key news. Want to discover 5 powerful TradingView indicators that could enhance your trading? See our latest review here.